Can you hear me, Jess? Okie doke. All right, folks. People are streaming in, so I'm going to go ahead and start. So I'm respectful of the time of those of you that are here. Get this cooking. Not going to be too long today, shooting for about 10, 15 minutes. Just want to give you a little bit of an update of what's been going on, and we'll jump on into this thing. So, all right, welcome. We're going to do a little bit of a recap of what happened in 2023 and then give some, oh, you can't see the slides. Let's see what's going on. Let's see why. Now, do you see the slides? I hope so. Let me see. It's yes, I can see the slides. All right, let's start over again. I don't know. You were just looking at me, I guess. That probably scared everybody off. But welcome. We're going to talk a little bit about Q4 2023, some stuff that happened, and then a short outlook of 2024. So again, we're going to try and keep it short and sweet so everybody can get back onto their day. Call me with any questions. But ultimately at our firm here, we stress this each time we do a webinar like this, is that knowledge is power. We really like to work with folks that we can get them as much information as possible. They're as educated as possible what's going on. And so these presentations give us an opportunity outside of our normal meetings and emails and things like that to kind of keep you up to speed. So let's jump into this thing and look at what happened last year. So Q4 of the S&P 500 and the Dow Jones turned out to be pretty good. We saw a nice rally. The year was moving along well prior to that, but we did see a pretty good pullback in the Q3 where the markets fell about 10%. And then things really surged nicely in October, November, December, which led to a pretty good year for the stock market, especially coming off of 2022, where it was pretty rough with both the stock and the bond market having significant drops. So if you look at it, the equity market, it's, the green line is showing a straight line up, but the reality is through that upswing, you're going to have your various ups and downs. And you can see on here the dip that we had in the Q3 that was quite substantial. And then everything kind of made its way back for those of you that are able to stay the course. Last year, things were really headed up by the technology sector. We saw a big rebound in big tech, and companies like NVIDIA, Apple, Amazon really participated well. And there were actually a lot of companies last year that did not do much. And if you were in any type of value-based stocks, real estate, things like that, a lot of things suffered, even though the overall stock market went up. It was really, truly handled by a handful of tech stocks. So what do we got going on? So inflation has been one of the big items that we've been trying to tackle for the past 2 years. It really zoomed up starting in 2021 and 2022. The Fed, to most folks' opinions, reacted a little bit late. And when they reacted in a pretty big manner. And so what they did is they raised interest rates quite substantially in a short period of time. We've seen that that's helped to bring the year-over-year inflation rates down. This is as of November 2023 at 3.1. We ran into a little bit of a headache a couple days ago. We were projecting 2.9% interest, but it came inflation, but it came in at 3.1. So that has that caused some of the disruption that you saw in the stock market this week. But right now we are seeing the trend line where inflation is going down. A lot of that's being driven by energy, and so that because energy was going through the roof with its prices prior to this, and so that's been helpful. Now, the Fed has also done a job here. So if you look at the charts, you know, we go back to 2002 and you can see where rates were. Historically, they were, you know, when you go over the long term, they've been much higher than where we are right now. We've just finished a period of very low interest rates for a while. So you can see starting in 2008, after the financial crash, we had very low rates for about 8 years. And then they slowly started to creep up in 2016. And then COVID hit in 2020, and you can see that big sharp decline downward. Now we pushed forward, inflation came, and the Fed decided to react, and they react in a very aggressive manner. That upswing you're seeing there is about as fast as we've seen, even faster than what we saw in the 70s. That caused havoc to the bond market. Anybody that held long-term bonds really felt it. With regards to us, what we did during that period, we knew the Fed was going to raise rates. We saw what was happening with inflation. So with us, we went a lot more towards short duration. We got rid of almost all of our long duration bonds, went to short duration, and we'll get into the reasoning on why we did that at that point. And now we're starting to look the other way. But as we go through it, here is just a calendar of what the Fed has been doing. The January 31st, that's another held steady. It says TBD, and there's going to be 7 more meetings that we'll see about what happens. But you can see we were moving up here with interest rate hikes. We had one hold in June, then one more in July, and then we've been holding steady since January again, held steady, and we'll see what happens going forward. A lot of the pundits are predicting that the Fed will lower rates as we may head into a recession. We're seeing it in a lot of parts of the economy, particularly the real estate sector has been in a tremendous recession. Commercial real estate is at the top of that. We're seeing towers in big cities selling for prices we've never seen before. So there are definitely parts of the economy that are truly feeling it. Other parts are doing really good right now. But it's interesting. You see tech stocks soaring, but they're one of the height of what we're seeing from a layoff perspective. So a lot going on there. So let's talk about interest rates and bonds and what I was talking about in 2022. When interest rates go up, you're going to see the value of bonds go down. So think of it this way. If you own a $10,000 bond, if you own one in 2022 that was paying 1.5% because rates were low, it's not unrealistic, a 10-year treasury bond. The Fed raised rates from 0 to 5.5. So the 10-year got pretty high where you could get a 4.5%, 5% 10-year treasury bond for a minute there at least. Now, if you have that 10-year bond at 1.5%, if you hold it for the 10 years for the duration of that loan, then you'll get your money back unless the government defaults. It's never happened before. But if you needed to sell that bond and people are able to purchase bonds at 5%, there's not going to be a lot of interest in buying your 1.5% bond. So that bond, you would have to discount it to sell it. So you might have to sell it at a 25 to 30% discount so someone finds it appealing to buy. That's what happened to bonds in 2022, and we saw a huge downturn in fixed income in that year. By going to a short duration bond, which I talked about earlier, if the bond is due in 3 months rather than 10 years, more than likely what you're going to do is hold that bond, wait to get the money back, and then maybe buy whatever you needed to buy at that point. So we don't see short-term bonds going down nearly as much as a long-term bond because your bond will be paid sooner. Now, again, inversely, if if interest rates go down, then expect your bond price to go up. So if you had a 5% bond right now and interest rates fall down to 3%, your 5% bond is a lot more valuable than a 3% bond. So that's something that we've been looking at with the portfolio in consideration of the Fed having this pause, in consideration of members of the Fed talking about potentially having rates fall towards the end of the year. We're starting to move a little bit into longer duration bonds. Not too heavy, because if we're wrong and rates start going up again, you can pay a pretty big price on that. And we're still getting paid pretty handsomely on the short-term bond. So it's a slow movement, and seeing once we can really get a trend on that. So let's look at Treasury yields. You can see where they're at from January of 2023 versus December of 2023. So January, the 5-year was a 3.94 and the 30-year was 3.88. The yield curve was inverted. You were paid more to be in a shorter term bond than you were in a longer term bond. Now we look at it, and the 5-year, at least as of December, was at 3.84. It's gone down a little bit. The 30-year has gone up. So that's a more traditional trajectory where you're paid more for the longer you're willing to hold that bond. So that's important to see. Now, money rates, this is as of December 25th. I mean, if you're not actively looking and searching out there, the banks will continue to hose you on interest rates. You can see the average as of bankrate.com, the 12-month CD is 1.94%. You really got to get out there and look, because there's no reason you shouldn't be getting north of 4.5%, 5% on CDs. The Fed fund rate is much higher than it was. Even a year ago, it was at 4.34, but prior to that, it was extraordinarily low. So there is money to be made in safety right now, and that's an area that we've really been able to help people out if you have a lot of money sitting in the bank. Earn on it. Now, what do we think from a recession standpoint? The indicators that we follow are talking more of a soft landing than a severe recession. Anything is possible. Like I said, our biggest fears stem from the commercial real estate market, particularly in the big cities where we're seeing these buildings selling at 20, 30, 40 cents on the dollar. A lot of these buildings sit empty. And so if that does happen, refinancing into an environment where rates are high, and a lot of these loans are owned by community banks to the tune of 1.7 trillion, that can have a pretty significant effect on the economy. So that is something that we're keeping an eye on, even though we're not invested in commercial real estate. We have very small exposure to that sector. And when we do, we prefer things like perhaps multi-tenant or industrial. But there's some things going out there. As long as interest rates stay high, that causes issues for these type of things. We see the residential real estate market has held up pretty good, mainly because nobody is selling. So the inventory is remaining low, which is keeping pricing high. But if rates start to come down, then you could see some movement there as well. So what else do we got to worry about? Geopolitical unrest, a lot of nonsense going on around the world. We have to keep our eye and see how this Russia-Ukraine affects the portfolios. The whole deal with the Middle East, with Israel, those are things that cause tension and unrest with regards to the markets. We never know what's going to happen with China and Taiwan. So hopefully those tensions subside and there's not too much going on there. But those are things that we keep in mind with the portfolio. So as it pertains to basically our long-term investors, we are in a cautious perspective right now, just advising folks, be careful. With your stocks and equities, though, being too cautious can be a problem. A lot of times people will jump ship and they've missed a pretty good year. A lot of things that happened in 2023, people would have jumped ship because of 2022 was so bad. And a lot of the problems existed in 2022 still exist today. Even though inflation's at 3.1, that's 3.1 on top of the 8% we went up last year. So there's a big problem that we're seeing with the middle class right now. They're really getting squeezed with regards to how inflation is working. So it's good that it's starting to come down, but it's not deflationary. Costs aren't going down. They're not going up as much as they were last year. So going to the grocery store, everything is just still a little bit more expensive. So that has an impact on folks. But it was important for us to stay long in the market. And that really helped people through the past year and a half, and things still seem to be going pretty good right now. We tend to be a little bit more proactive here, so you will see a lot of moves in your portfolio. And so give us a call if you've seen some stuff that looks a little bit different. We'll talk about the positions that we've been adding and why we're doing that. But right now, we're pretty thrilled with the returns. The key takeaways here, not to drag on too long, but inflation does seem to be slowing. It's a concern. Again, the news that came out Wednesday, there was an uptick. We were expecting 2.9, came in 3.1. If that starts going back the other way, could be a real headache. Hopefully that's done. One of the Fed chairmen came out and said, even if rates remain flat, or excuse me, inflation remains flat here, maybe they'll come off the 2% target. They're trying to get inflation down to 2%. And by coming off of that, meaning they might even lower rates, even if inflation remains where it's at, about 3%, which is the historical norm. Potentially, we'll have interest rate cuts. That seemed a lot more viable when this was drawn up. But again, that changed on Wednesday when inflation went up. Volatility is going to remain here, and it really depends on your ability to pick stocks, because even though the market went up considerably last year, a lot of good stocks did not do much last year. Very low returns. So you could, depending on what your portfolio is about, you could see some funny stuff where it just didn't perform. We project more of a soft landing than a full-blown recession. And again, always advising stay the course with your long-term money. The stock market is not a good place for you to put money for near-term goals. If you're looking to buy a house next year, don't put your money in the S&P 500. Keep it somewhere safe where you know it's there and you can use it. Long-term, 5, 10, 15 years, ride through them, stay the course, and always be well prepared. So we're going to wrap it up here. Just want to let you know that we do appreciate you. And always remember, we're not one of these big Wall Street firms where we get giant bonuses when we crash the company. The only way we get a bonus is if you introduce us to someone. So the best compliment you can give us is an introduction or referral. So keep us in mind. If you're not ready to refer somebody, but you know someone that might be interested, maybe we add them to our mailing list, and we do a great newsletter that you might want, or you can invite them to our next presentation. So this will be recorded as well, so you'll be able to pass that on if anybody's interested. But I really want to thank you for working with us and continuing and helping us navigate your financial future. Now, of course, the most important slide of the presentation is going to be our compliance slide. And I need to be sure to leave it up because I have gotten my hand slapped for getting on too quickly. I know you guys all want to see this. So read this diligently and understand where we got this from. But I am going to open the door in case anybody has any questions. So don't be shy. There's a little chat feature or a Q&A feature up here that you can drop into that thing. And keep in mind, if you are getting nervous of the market, we have some pretty neat solutions out there that could make some sense for you too, because with rates going up, there have been some things we haven't seen in about 15, 20 years. So give us a call on that. I don't want to get too much into product on a call like this. I'll give it a couple seconds in case you have a question. All right. Well, you guys are awesome, and I appreciate you taking the time to spend 10, 15 minutes with me today. If you have any follow-up questions, drop me an email, give me a call, and we'll go from there. We'll plan on doing something like this in the second quarter as well, just give you a mid-year outlook and then a year-end outlook, and every now and then maybe we'll put something together for taxes. But appreciate you stopping by today. And again, this will be available on the web if you're really itching to see it again. Have a good one.